But many critics argue that this is misleading, as the liquidity provided by high-frequency traders is unreliable compared with that provided by banks. It disappears in crises, the argument goes. A recent paper published by Citadel Securities, a trading firm, refutes this view. It shows that the spread for executing a small trade of, say $10,000 in a single company's stock has fallen dramatically over the past decade and is consistently low. Those for larger trades of up to $10 million have, at worst, remained the same and in most cases improved. The machine's market dominance is sure to extend further. The strategy of factors that humans devised when technology was more basic is now widely available through ETFs. Some ETFs seek out stocks with more than one factor. Others follow a risk parity strategy, an approach pioneered by Mr. Dalio which balances the volatility of assets in different classes. Each added level of complexity leaves less for human stock pickers to do. 30 years ago the best fund manager was the one with the best intuition, says David Siegel, co-chairman of 2 Sigma. Now those who take a scientific approach, using machines, data and AI can have an edge. To understand the coming developments in the market, chess offers an instructive example. In 1997 Deep Blue, an IBM supercomputer, beat Garry Kasparov, the reigning world champion. It was a triumph of machine over man up to a point. Deep Blue had been programmed using rules written by human players. It played in a human style, but better and more quickly than any human could. Jump to 2017, when Google unveiled AlphaZero, a computer that had been given the rules of chess and then taught itself how to play. It took 4 hours of training to be able to beat Stockfish, the best chess machine programmed with human tactics. Intriguingly, AlphaZero made what looked like blunders to human eyes. For example, in the middle game it sacrificed a bishop for a strategic advantage that became clear only much later. Quant funds can be divided into 2 groups, those like Stockfish, which use machines to mimic human strategies, and those like AlphaZero, which create strategies themselves. For 30 years quantitative investing started with a hypothesis, says a quant investor. Investors would test it against historical data and make a judgment as to whether it would continue to be useful. Now the order has been reversed. We start with the data and look for a hypothesis, he says. Humans are not out of the picture entirely. Their role is to pick and choose which data to feed into the machine. You have to tell the algorithm what data to look at, says the same investor. If you apply a machine learning algorithm to too large a dataset, often it tends to revert to a very simple strategy, like momentum. But just as AlphaZero found strategies that looked distinctly inhuman, Mr. Jacobs of Lazard says AI-driven algorithmic investing often identifies factors that humans have not. The human minders may seek to understand what the machine has spotted to find new explainable factors. Such new factors will eventually join the current ones. But for a time they will give an advantage to those who hold them. Many are cautious. Brian Kelly of Yale University, who is AQR's head of machine learning, says the firm has found purely machine-derived factors that appeared to outperform for a while. But in the end they turned out to be spurious. He says combining machine learning with economic theory works better. Others are outright skeptics, among them Mr. Dalio. In chess, he points out, the rules stay the same. Markets, by contrast, evolve, not least because people learn, and what they learn becomes incorporated in prices. If somebody discovers what you've discovered, not only is it worthless, but it becomes over-discounted, and it will produce losses. There is no guarantee that strategies that worked before will work again, he says. A machine learning strategy that does not employ human logic is bound to blow up eventually if it's not accompanied by deep understanding. Nor are the available data as useful as might initially be thought. Traditional hedge fund managers now analyze all sorts of data to inform their stock-picking decisions, from credit card records to satellite images of inventories to flight charters for private jets. But this proliferation of data does not necessarily allow machines to take over the central job of discovering new investment factors. The reason is that by the standards of AI applications, the relevant datasets are tiny. What determines the amount of data that you really have to work from is the size of the thing that you're trying to forecast, says Mr. Kelly. For investors in the stock market, that might be monthly returns, for which there are several decades worth of data, just a few hundred data points. That is nothing compared with the gigabytes of data used to train algorithms to recognize faces or drive cars. An oft-heard complaint about machine-driven investing takes quite the opposite tack. It is not a swizz, say these critics, far from it. It is terrifying. One fear is that these algorithms might prompt more frequent and sudden shocks to share prices. Of particular concern are flash crashes. In 2010, more than 5% was wiped off the value of the S&P 500 in a matter of minutes. In 2014, bond prices rallied sharply by more than 5%, again in a matter of minutes. In both cases, markets had mostly normalized by the end of the day, but the shallowness of liquidity provided by high-frequency traders was blamed by the regulators as possibly exacerbating the moves. Anxieties that the machine takeover has made markets unmanageably volatile reached a frenzy last December, as prices plummeted on little news, and during the summer as they gyrated wildly. In 1987, so-called program trading, which sold stocks during a market dip, contributed to the Black Monday rout, when the Dow Jones Index fell by 22% in a single day. But the problem then was hurting money managers clustering around a single strategy. Today, greater variety exists, with different investment funds using varying data sources, time horizons, and strategies. Algorithmic trading has been made a scapegoat, argues Michael Mendelson of AQR. When markets fall, investors have to explain that loss. And when they don't understand, they blame a computer. Machines might even calm markets, he thinks. Computers do not panic. Money never sleeps. Another gripe is that traditional asset managers can no longer compete. Public markets are becoming winner-takes-all, complains one of the world's largest asset managers. I don't think we can even come close to competing in this game, he says. Philippe Jabra, who launched his hotly anticipated eponymous fund, Jabra Capital, in 2007, said that computerized models had imperceptibly replaced traditional actors in his final letter to clients as he closed some funds last December. And there remains a genuine fear. What happens if quant funds fulfill the promises of their wildest boosters? Stock markets are central to modern economies. They match companies in need of cash with investors and signal how well companies are doing. How they operate has big implications for financial stability and corporate governance. It is therefore significant that algorithms untethered from human decision-making are starting to call the shots. The prospect of gaining an edge from machine-derived factors will entice other money managers to pile in. It is natural to be fearful of the consequences, for it is a leap into the unknown. But the more accurate and efficient markets are, the better both investors and companies are served. If history is a guide, any new trading advantage will first benefit just a few. But the market is relentless. The source of that advantage will become public and copied. And something new will be understood, not just about the stock market, but about the world that it reflects.